9.1% is the June 2022 CPI data. You say 11%. Explain the difference.
Yeah, so if you look at it on a year-over-year rate of change basis, so like June of 22, taking the percentage change from June of 21, you'd wind up at 9.1%. But the more concerning issue is that we continue to accelerate on a trending basis. So looking at it on a 3-month annualized percentage change basis, we actually came in at 10.6%. So the time series continues to move away from the Fed's target and pushing us into a direction of more and more tightening. This report was a disaster across the board from the perspective of anybody who is anticipating on inflation, A, returning back towards chin on any reasonable time frame, or B, anticipating a sort of what we've been talking about in the program, or Federal Reserve ambulance sirens anytime soon.
So when you see that, why do they use the 9.1%, the 12-month year over year versus the 3-month annualized? Is it because the 12-month looks better, or is there some other argument?
Well, no, so it's traditionally how you want to calculate in sort of time series for the most part, particularly inflation. You want to look at it on a 12 year-over-year basis, kind of removes all the seasonality that tends to be associated with different cycles in the economy, housing, consumer cycles, et cetera, et cetera. And so that's the cleanest read on a time series, for something like inflation. The problem is for COVID, we've had so many fits and starts as it relates to the different variants and the proliferation therein, that it's been the time series on a year-over-year rate of change basis has been noisy. And to a degree, these inflation statistics are being flattered by some of the sort of advent of Delta that we saw, kind of the beginning of Delta that we saw in the summer of last year. But again, that's not the issue. The issue is that it actually is accelerating sequentially now. If you look at it over the last 3 months and annualize that percentage change, inflation on a headline basis is coming in at 10.6%. That's the fastest number we've seen in a few months. But more importantly, things like core inflation reaccelerating to, where we at 7.7% on a 3-month annualized basis. And my two favorite statistics, something we've been talking about literally all year on the program, are median CPI and sticky CPI. So median CPI, what's the rate of change of all the different components of the entire CPI basket? There's hundreds of components. That is accelerating to 7.4% on a 3-month annualized basis, which means the median 3-month annualized rate of change of every single thing in the inflation basket is growing at a rate of 7.4%. And then if you look at isolate the variables that are most sticky, that tend to be less responsive to changes in the economy, and that tend to have prices move in a much more autocorrelated gradual fashion, that is running at 7.6% on a 3-month annualized basis. That is a 40-year high for that particular time series.
When you start to look at this, we saw the Federal Reserve in November and December talk tough. In 2022, they started to raise interest rates, and they've gotten more and more aggressive. They claim that they're going to do quantitative tightening and start selling assets off their balance sheet. While they're doing that, and interest rates are going up, inflation is accelerating as well, both on a year-over-year basis, but also this 3-month annualized basis. Why is that happening? And does this mean in July we're just getting a big fat 1% interest rate hike, and they're going to try to bring the big boy weapons to the war now?
Yeah. So, I think one thing that's to answer your question, I think 100 basis points of a rate hike is very much on the table for the Fed's July 27th FOMC meeting. I think the bigger issue is, do they stay at this pace, right? Because right now the Fed is operating currently under a framework that says R star, the neutral rate of the neutral interest rate, the interest rate that sort of causes the economy to neither accelerate nor decelerate, is somewhere around 2.5%. At least that's what Powell said their estimates were. The committee's estimates were going back to that last FOMC meeting on June 15th. We might start to get to a process whereby the Fed, looking at the data, is sort of saying, hey, look, our policy is being really ineffective in terms of moving the needle on inflation. Maybe we have to revise up our expectations of R star, and then we actually have to start speeding up the pace of tightening. That's certainly something that has not happened yet, and very much could happen if inflation continues to surprise to the upside in the coming months.
You've got a couple of charts here. The first is U.S. headline CPI, energy and agriculture can't crash fast enough. Explain why you think that.
Yeah, so we've seen, commodity prices, if you look at industrial metals, energy, agricultural prices, energy prices, et cetera, are really starting to decline. If you look at it on an index basis, industrial metals are off somewhere around 30% off their highs, agricultural and energy around off 20+% off their highs. But as you can see in the food and energy price inflation, we accelerated to 12.2% on food. We declined to 35% on a 3-month annualized basis for energy, but obviously 35% is not a reasonable number if you're trying to get inflation under control. And that's my point, is that it's going to take time for the moves in commodity markets to be reflected in inflation statistics. It could take several months before those kinds of moves are actually, adequately pushing inflation statistics down. So that's the first chart. That's kind of the first key takeaway there. It's that we might have to go through some more pain over a number of months before we actually see those declines reflected in the statistics.
When you look at this next chart that we have here, you've got that both goods and service prices are melting up. Explain this.
Yeah, so this is goes back to something we talked about this winter. We were like, hey, look, there's the goods disinflation is likely to become the driver of core CPI. And for a moment there, it was causing core CPI to slow because we saw sort of the unwind of supply chain disruptions. We saw sort of consumers shift their purchasing, the dominance of their purchasing from goods to services. That's something that's happened in the first half of this year as well. If you look at the sort of the rate of change between goods and services, about a 9 to 10, about 1,000 basis points of a difference between the growth rate of services consumption and the growth rate of goods consumption. So that caused, for a brief moment in time, core inflationary pressures to back off because goods was moving down faster than services was going up. Well, now you got both of them going up simultaneously. If you look at, again, I mentioned core goods inflation was at 6.6%, core services inflation at 8.2%. Those two numbers are moving away from the actual year-over-year time series, which tells you that we're still building momentum to the upside in core inflationary pressures. And this is exactly what you would expect. Inflation is a lagging indicator to the broader economic cycle, and you typically see core inflationary pressures peter out last as you head into start and sort of middle parts of a recession.
You've got leading indicators are rocketing past the moon, which is just an all-time title for a slide. What does this say?
Yeah. Thank you. Just to borrow some crypto lingos, let the kids know that I'm still hip. Anyway, so what we're showing here in this chart, as I mentioned, the first set of bars. The gray, by the way, to explain these bars, the gray bar just shows the prior month's 3-month annualized rate of change, and the blue bar is the most recent month, so June. As you can see, we're moving in the wrong direction if we're trying to get core PCE down, right? Median CPI, again, the median of everything in the inflation basket, is now accelerating at a 7.4% annualized rate of change. It's the highest 3-month rate of change, annualized rate of change we've ever seen in median CPI as time series goes back to the early 80s. If you look at it, the Atlanta Fed's got a sticky CPI, as I mentioned earlier. That basket is accelerating at 7.6% on a 3-month annualized basis, the fastest print we've seen since August of 1982. Neither you nor I nor John were born in August of 1982. So the Fed's got a real serious inflation problem on their hands. And what I mean by that is that those two time series are very highly correlated to the third set of bars, which is core PCE, which is the Fed's preferred inflation metric. So that's obviously an issue.